Hello, my friends. How are you? Welcome back. It's good to see you. It's a great show today. And I think before I get into it, let's see who's on here. Let's see who's, I see people streaming in slowly. Alex, I can't see the participants over here, though. So, I see people streaming in. We're still wrapping up the preparations. Should be done in a few minutes. Just let me know when we're ready to go. Are we what? Henry. Hi, Henry. How are you? It's good to see you. All right. We see people streaming in. We just got started. We're going to have a fun show today. How's your day, Henry? It's going well? All right. I had a great holiday. I had a great July 4th. What did I do? I slept. I was tired. I was really tired, so it was a long week, before the week of July 4th. When you run a technology company and a finance and wealth management firm, you're busy, throughout the day, throughout the week. And sometimes, those holidays, friends and family are good, but sometimes I just want to sleep. Which is what I did for July 4th. So we'll wait for a few more people. I see my people always stream. Sometimes people are on time. Today they're coming in very slowly. So I think we can, normally, hey T-Pal, normally I'm the one who's late, starting. So it looks like today, is this an overhang? Hey Yvonne, you see people are streaming in. I thought maybe that's overhang from the short week. Because we did have a short week. Hope everybody had a good July 4th. Like I said, I did nothing but sleep. I did this show and I went straight to bed. I spent a lot of time watching Netflix and just relaxing, Netflix and chill. So we'll see. We'll see. Where's the family? We're ready. Well, the family's coming. The family's coming. We want the rest of it. We want Darlene. We want Cece. We're going to wait for the rest of the crew. I think today is a slow day. So, well, you know what we're going to do going forward? We're going to make these shows short because, like I said, I'm going to have my own show. I'm going to have my own website launch. And we're going to, do a lot of interactive stuff, a lot of the personal stuff. So today, hey, Danisa, good to see you. Welcome. Good evening. It's afternoon my time, so I'm assuming you're on the East Coast. I think you were actually on the East Coast. It's evening now. And so these shows are going to be short and to the point. The finance shows, they're intended to teach you about things that will help, raise you, uplift you to make more money, to be wealthier. And on the other show, which we're going to start hopefully sometime next week or the week after, I'll let you know. That's a more personal show. That's more about, talking to people. It'll be a lot more interactive. So we'll just give it a few more minutes, maybe one more minute, and then we'll jump into the show, which is a very unique show today. Because normally I don't talk about, how to make money quickly. I talk about slow. Today we're going to talk about quick. And you will have a good idea, if you can tolerate it, how to make a lot of money very quickly, but at the same time, taking on a significant amount of risk. So, Alex, you let me know when a good time is to jump into the topic. And I will. How was everybody's weekend going? You guys having a good time? My weekend is, yesterday was, I went out with a great group of friends. Now that things are opening up, an older group of friends. A good friend of mine, one of the best lawyers in America. He's in his 70s now, and his wife. We went out together. Had a really nice dinner downtown LA. So hope everybody had a good week, had a good weekend, and it's relaxing. So you let me know when the time is to jump into the topic. I should start. Okay, my friends, we are going to talk today about something that I don't normally talk about. I don't normally talk about ways to double your money. And the reason why is because, the best way in general that I found from my 30 years of finance experience, 18 years running my own wealth management firm, Wall Street investment banker, Harvard MBA, and all that stuff, the best way is when you diversify your portfolio, right? You diversify your portfolio, bunch of stocks, bunch of bonds, and you invest over a long period of time, and you put in small amounts or large amounts, if you can afford it, of money into your that account. That's typically the best way to make to create wealth. Just leave the money and let it grow. It's even better when you do it in your 401k, right? So imagine if you didn't have to pay any taxes until you take that money out. And imagine if your company matches, right? So let me give you a quick example of how to double your money when it comes to the slower way, the more steady way, the way we advocate. Imagine if your investments, stocks over the last, 50 years have grown by about 10% per year, annual average. Sometimes it goes up 25, 30%. Sometimes it goes down 25, 30%. But overall, about a 10% rate of return over the last 50 years. That means your money will double in 7.2 years. It's just the rule of 72. Which means it'll quadruple in about 15 years. You'll have 4 times the amount of money in 15 years, and so on and so forth. So for most people, that's good enough. But for the brave of heart, for those amongst us who want to wear the badge of doubling your money quickly, for those people who have the following, I'd say, they have the following characteristics. They like to take risk. Okay, if you like to take risk, well, this is the right show for you. They want to make money quickly, which means who wants to wait for 7.2 years to double your money, right? Growing at 10%. They want to double their money next month, or by the end of the year, or maybe even next week. It is possible. But it comes with certain risks. So, as I tell you these strategies and these structures, and I'll tell you all 10 of them before we start, so you know what we're going to talk about. Before you invest in these strategies, make sure, number one, don't put all your money in there. Put a small part of your money in there. Number two, make sure that it's not money that you need to pay your mortgage, or to pay your rent, or to buy a car, or for retirement, or for your daughter's college. No. Make sure this is what we call play money. That's money that's available, and if you lose it, well, it hurts, but not too much. You don't lose your house. They don't foreclose on your home. So make sure it's money that's available. So if it doubles, you're happy, but it doesn't change your lifestyle. The 10 things we're going to talk about. First of all, this thing about doubling money, it's sort of a badge of honor. I don't hear about people saying I made 5 times, I made 6 times. I hear people say I doubled my money. It's something people aspire to. And I will show you those ways today. You can double your money in some of these strategies in one day, in 1 week, in 1 month. But you could also lose a lot. I will talk about those. So let's jump in. The 10 things we're going to talk about today. And by the way, I wanted things you could do at home in your pajamas. I didn't want things where you had to go out and work. And this is still work, but it's a different type of work. You're doing it at home. The pandemic changed things. Now, people are learning how to make money by sitting in front of their computers or on the phones. So these strategies do not require you to leave your house. All you need is a computer, maybe a phone, a little bit of cash, and a lot of brains. And of course, a heck of a lot of guts. Always remember, I'm a financial advisor. I don't know your situation. So the advice I'm giving you is general, right? Don't necessarily just go out and buy. Look at your situation. Talk to your financial advisor or your CPA or a close friend who knows about investments, right? Before you make any decision that could significantly impact your life. So the 10 things we're going to talk about where you can make money as quickly as you need to are, number one, stock options. You can trade stock options and make a lot of money. Number two, shorting. That's the contrarian. That's kind of like, the contrarian perspective. When people buy, you sell. When people sell, you buy. Futures. Not the future you're thinking about, next year. Well, you can actually buy these things using a strategy called futures and make a lot of money. Margin trading. It's very simple. Same strategy we're talking about, only you use borrowed money. I love borrowed money. I love using other people's money, but you do have to be careful. It goes up and it goes down. And that double-edged sword could hurt you both ways. Leveraged ETFs, which means margin involves you doing the work. You borrow, you invest using borrowed money. Buying a leveraged ETF is just like buying margin, but you don't do the work. You have somebody else do the work. Day trading. Many of you have heard about day trading. You could make a lot of money applying the right strategies and using the right structure, but you could also lose. We'll talk about that. Penny stocks. Those are stocks that you trade that are under $5, not the $120, $150, $200 stocks. Those are a little bit pricey. Penny stocks. Trading cryptocurrency. Yes. You could make money, a lot of money trading cryptocurrency. You could lose too, but you could also make a lot of money. You just got to do your homework. IPO stocks. IPO stands for initial public offering. You can make a lot of money trading initial public offering stocks, right? Actually, buying initial public offering stocks as soon as you can the day they start trading. And the final thing we'll talk about, currency trading. How to make a lot of money trading currencies. So, my friends, let's jump in. Okay, first one is stock options. What's a stock option, right? And how do you make a lot of money? Sometimes double your money in a day or a week using stock options. Now, I'm going to tell you the risks also, but here's what a stock option is. A stock option gives you the right to buy or sell a security, sometimes a stock or bond or any other security, at a set price called a strike price, right? You have the right to buy or sell a security at a set price within a certain period of time. So let me give you an example. It's a stock many of you know I like called Apple. APPL is the ticker. You can buy a stock of Apple for $145, right? And you can buy that stock and hold on to it. Or you could pay a few cents on the dollar and get the right to buy Apple. If Apple goes up, you get the right to buy Apple at $145 a share. Wow. Talk about making money from nothing. Imagine that. You get to pay a low premium, a few dollars, for the right to buy Apple. Let's say if Apple goes up to $180. You could potentially buy Apple at $145 today. The price today. And if it goes up to $180 in the next 3 months, you actually pay $145 today, $145 in 3 months. The price today, you pay $145 for the stock that's worth $180. How does that work? It's beautiful, isn't it? It's called a call option. The opposite is the same. If you think Apple is going to go down I don't know, something's going on. Maybe you think China is going to come after Apple. And China is coming after everybody. Alibaba and Didi, now they're coming after Apple. Huh? Okay. If you think so, then you may think Apple will go down in value. So maybe you think it's going to go down to about 120. So here's what you do. You buy a put option, PUT. That means you have the right. If Apple goes down to 120, you have the right to sell that stock of Apple for $145, today's price, after it goes down to 120, and you make $25. That's what an option is. There's call options, options that give you the right to buy a stock, and there's put options, options that give you the right to sell a stock or a bond or something, some other security. Now, the amazing thing about stock options is the investment is very small that's required. You don't have to put in a lot of money. You can actually buy a stock of, if you think Apple is going to $200 and you want the ability to be able to buy it to be able to buy that stock at $200 for $145, you could put a couple of bucks down now and pay somebody, give somebody that, what you call a premium. If it goes up to $200, you just cashed out. You made what, $55, and all you had to do was a couple of bucks? The good thing is it requires only a small amount of capital, and you can make a lot of money. Magnified gains, right? But it has a limited time to exercise. So for example, if you buy the stock of Apple, you could just hold on to it. It goes up, goes down, goes up, goes down. Who cares? Eventually it'll go up, right? Because it's a good company, right? With an option, you only have it for a specific period of time. You only have the right. And so if the right expires and it hasn't gone up or gone down as you expect, then you have to buy it again. That requires capital. So even though the investment is small, it requires capital. Commission cost. Now there's free trading everywhere. TD Ameritrade, Robinhood, everybody's free. Fidelity, everybody's free trading. But options, you got to pay for that, right? Usually you have to pay to buy options or to sell options. So there's an additional cost, sometimes above and beyond what you would pay for a normal stock. Unlimited losses. Whew. There is something called, and I'm going to give you this strategy, but please don't do it. It's called selling a naked put. And I'm not going to describe it here, but it's pretty much PUT. It's pretty much selling the right for somebody to buy, selling the right. Remember, buying a put is when you have the right to buy something. Well, who's the person on the other side? That could be you. You could take those $2 or $3 premiums and give somebody the right to sell a stock to you. The danger is that stock keeps going up, unlimited. Apple could go up from 145 to 150 to 200 to 500 to 1,000 or 2,000. And if somebody has the right to buy stock from you at that price of 145, when it's now 350, 400, $500, you're out of your unlimited losses. You could lose your shirt. So stock options could be a great investment if you know what you're doing. And sometimes they're good to hedge a portfolio. So if you have a stock, right, and you think the stock could go up or down, you're not sure, but you've already made a lot of gains on the stock, right? You could actually sell a put, you could buy a put option, right, that gives you the right to lock in your profits. Or you could sell a call. So there's ways that stock options could benefit you. But because of the small investment required and the potentially massive gains, stock options are the first and one of the simplest ways. Simplest meaning not about the structure itself, but the simplest in terms of executing. You go on any platform and you can buy options to double your money quickly. That's number one. Hello, Celia. It's good to see you. Grace Mwenda. It's a pleasure to see you. Good to see everybody over here. We're talking about ways to double your money. And by the way, if you haven't subscribed we have about 5,500 people. If you haven't subscribed, please subscribe, hit the subscribe button now. And if you're on Instagram, if you're one of my friends on Instagram, please go to YouTube where I can see you. I can interact with you like I'm interacting with Celia and all my other friends out here. Please go subscribe. Just hit the subscribe button so you can know all the good stuff that's coming. The second way for you to double your money really quickly is by shorting. Shorting is a technique that is used often now by these people we call hedge funds. And pretty much what you're doing is a complicated, interesting strategy that I call one of the magics of modern day finance. You're selling a stock that you don't own. That strategy means you go out and let's just say you want to short Apple because you think Apple is going to go down, right? It's a strategy when you think it's going to go down. You go out and you buy a stock, you borrow a stock of Apple. You got to give them a few bucks. You borrow a stock of Apple. You sell that stock that you don't own. Apple is trading at $145 now. Now you just sold it for $140, but you don't own the stock. After a while, the owner of the stock is going to come over to you and say, give me my stock back. If Apple has dropped to, let's just say, $100, woo! Remember, you sold the stock at $145, today's price. The stock dropped to $100. Now you buy it at $100, and you give it back to the guy or the gal. You just made $45. You can make it in a day, a week, a month, a year. If you do multiple strategies, you could make so much money. But the flip side of shorting is exactly what I just said with buying or selling stock options. Your losses could be unlimited. If you short a stock of Apple at 145, you think it's going to go down to 100, you go to bed, you wake up about 2 months later, and Apple is at $400. Now you got to buy it back. Remember, you sold it at 145. Now you got to buy it at $300 or $400. And you got to return it to that. You just made a massive loss. There is no telling how high Apple stock can go. So if you're going to short, make sure if you're not a sophisticated investor, only short stock that you own if you've locked in a profit. For example, if you bought Apple at $40, Apple is now $105. Apple is now $145, and you think Apple could go down, you could short the stock. That way, because you own the stock, if it keeps going up, eventually you just turn around and you don't have to buy it back. You just give your stock, if it goes up, to the guy who you borrowed it from. And if it goes down, bingo. You still have the stock. It went down, no worries, it'll come back. But you're able to sell it to the person who you are on the other side of the short. So that's a strategy you can use to make money. And that strategy of shorting, it's dangerous, but you could use it to make a lot of money. Hi, Ruby. Oh, thank you. That's what. Hey, Kim. It's good to see you. Where's all the men? I see a lot of beautiful women over here. Where's the men? We need the men to speak up over here. Don't be shy. We got a lot of beautiful ladies over here, but the men shouldn't be shy to speak. I want to, because these are strategies. These are, strategies that could make you a lot of money. And we need you to, help support the women too sometimes. And, sometimes you got to jump in and do some trading yourself. So the third thing we're going to talk about, ways to double your money pretty fast, is something that's also not for the faint of heart. It's called futures. Again, not the future with your family or your spouse that you're thinking about. No. Futures in finance means you enter into an agreement to buy or sell a commodity at a preset price in the future. So if you think, for example, that oil is going to go from, I think what it is, $75 today to $100 in a few months, you could pay a few bucks today, enter a contract, you guys sign, and you now have the right to buy that stock that's going to be 100, to buy the oil that's going to be 100, you have the right to buy it at 75. That's the price today. And if it goes up, woo, yes, you made a lot of money. Remember, there's not a lot of cash that changes hands. There's a little premium, but you don't have to put up the price. You don't have to put up $75. All of these strategies I'm teaching you require very minimal capital. You don't need a lot of capital. And that's, if you have to go out and buy a stock or buy multiple stocks, that requires you putting a lot of cash down. With these strategies, you don't need a lot of cash. You need a small amount of money. And you want some of these strategies, whether it's leveraging or it's options, could make you a lot of money. It could also lose you money, but if you do it right, you could make money quickly. So a future essentially is where you get to buy that oil. Now, the problem is, if oil goes up, you just bought it at 75. Now it's going up to 100. What if it goes down to 50? You just lost your shirt. So a future is something that also has a few complications. Imagine if, like cocoa, like tin, like rubber, like iron ore, imagine if you bought like a whole ton of gold, or oil. So you bought, a few thousand barrels of oil because you think it's going to go up, right? And the time comes, you bought the oil, you already paid for it. They want to deliver it to you so you can pay the premium. You want to remember, you're only paying a small price for the right to buy it. Now you got to come up with the cash for the whole thing, and you have to store that oil. Where you going to store like a few thousand barrels of oil? Most of the time, you never have to take delivery. In the financial markets, the strategy is you can pay. When the time comes, you settle. So if the oil is up, you get cash. If oil is down, you have to pay cash. So futures are a great way to make money because it only requires a very small piece of capital, and it's a way for you to make a lot of money with your investments. That's number 3. Okay. Let's see who else is on here. I see Ruby on here, Carissa, Rhoda, very dangerous. That's why I day trade and swing. Yeah, day trading could get you. We're going to talk about day trading some more in a little bit. Nadia asked a question. Should we have professionals do this for us? We should have professionals do this for us, right? Absolutely. Now, I qualify that question a little bit because I happen to think you are as smart as any professional. You may not just have the time or the inclination, the willingness to do it. So if that's your situation and you don't have the time or the interest, yes, please have a professional do it for you. If you want to do any, but maybe you don't even need any of these strategies. If you were here in the beginning, I showed you the surest way to raise money. The surest way to make money. Diversified portfolio inside of your 401k, get the company match, put in small amounts every month, and just watch your money grow. Become a millionaire. But if you want to make money faster, a lot faster, those are the strategies I'm teaching you. So if you don't have the time or the willingness, have a professional do it for you. But if you do have the time and you have an interest, I've taught many of my clients how to trade options. I've taught many of our clients how to trade commodities. I've taught them, I said, go do it. Don't spend all your money because we still manage the bulk of the money for them. But from time to time, they want to put a couple of grand into shorting stuff. Go for it, but be careful. You can do it yourself if you have the time. There's a lot of reading material, online. There's a lot of places you can go. Just Google any of these things I'm talking about, and then go to one of those sites. I don't want to recommend those sites because we got to be careful about you sending the people to places where sometimes they could make a lot of money, but they could also lose a lot of money. They lose, they can come back to me and you're like, yeah, you told me to go on that website. But there's there's dozens and dozens of websites where you can do any of these strategies. You can do it yourself if you have the time. You're just as smart as your financial advisor. He or she probably doesn't know a lot more than you do about trading options. So did I answer your question? Let's go back into the 4th way to double your money fast is what we call margin trading. Now, margin trading is interesting because it simply means you're borrowing money to buy stocks. Many people are like, I don't want to borrow money to buy stocks. Why? But you borrow money to buy real estate. You want to buy a piece of real estate for $200,000, right? Instead of you putting in 100% of your money, because you could do that. You could put up to $200,000, buy the house. The house doubles in value in the next 10 years. You just made $200,000, 100% profit. What if you borrow 50% to buy that house? So you put in $100,000 and you borrow $100,000. And then the real estate price of the home, like before, doubled to $400,000. Now, how much did you make? Remember, you borrowed $100,000. You pay off that $100,000. You just made $200,000 on your $100,000 investment. You made 200%. That's the power of leverage. It helps you magnify your returns on the way up. The problem is, on the way down, it also magnifies your losses. What I just described in real estate, the same thing applies with stocks, right? So Apple is trading at $145, right? You can pay up to $145 and buy one stock of Apple, or you could go 3 times leverage, right? And borrow 3 times as much. If you just bought the stock for $145, the stock goes up 10%, you make $14.50, right? 10%, $14.50. Stock goes down, you lost 10%, $14.50, 10%. What if you used margin? You borrowed 3 times, which means you can only normally afford $145, but you want to buy 3 stock of Apple. So, or 3 shares of Apple. So you borrowed the balance. Now you have 3 shares worth $435, not $145. Remember, you only put in $145 with both. The first one, you only bought 1 stock. The second one, you bought 3 shares of stock because you borrowed the excess. What if Apple goes up by 10%? In the first example, you made $14.50. On the second example, you made what? 3 times more, $43.50. Wow. You just made 30%. Talk about doubling your money, right? You just made 30%. The only problem is if Apple goes down 10%. Well, the first example, where you put in your own cash to buy 1 stock, $145 Apple stock, if it goes down in value by 10%, you lost 10%, $14.50. But if you borrowed on margin, instead of going up by 10%, if Apple goes down 10%, how much do you lose? Not $14.50, you lose $43.50, 30%. So what margin does, and many people don't know this about real estate. When you take on a mortgage loan, you're borrowing, like margin. It's not for stock, it's for real estate. And when real estate values go up, your returns are magnified. That's why a lot of people think real estate makes them a lot of money. Real estate doesn't. The last 25, 30 years, real estate has only grown at about 5.4% per year. I apologize, 4.8% per year. Inflation is 5.4, 4.5%, 4.8% per year. What that means is, if it only makes you less than 5%, why do people talk about real estate making you a lot of money? Because they use leverage. And especially if you're borrowing 80% and you're putting down 20%, that's a massive amount of leverage. So instead of making if the stock market, if the real estate market goes up 5%, instead of making 5%, you're making like 20%, somewhere around there. But if real estate prices go down, you're going to lose the same thing, 20% instead of 5%. That's what leverage does. The same thing with buying stocks on margin. When it goes up, it's magnified. When it goes down, it's magnified. It's a great tool for you to use if you want to make money quickly. You can double, triple, quadruple your money in a week, 2 weeks, 3 weeks, depending on the price, how much margin, and also depending on how fast the stock moves up or moves down. But when you combine margin with options, remember options are already souped up securities, stock options, and you buy stock options on margin, woo, it's like being in a Corvette, top down, and riding on the highway at about 100 miles an hour. And you know the cops ain't gonna stop you, but you could die. So please adhere to the rules of be careful. With some of these strategies, they're thrilling. When you make money, it's a lot of money and it's exciting, but you could also lose a lot of money. So be careful about that. Okay. Now, instead of buying stocks on margin, look, if you buy a stock on margin, you have to actually, if you borrow money to buy stocks, you have to pick the stock. Now you're using borrowed money. So you have to do a lot of, research. Well, what if you don't want to do too much research, right? You could actually buy stocks on margin, but instead of buying it directly, you could buy it through what you call a leveraged ETF, leveraged exchange traded fund. An exchange traded fund is a fund, we talked about it last week, where it's a basket of stocks, a collection of stocks that are all kind of similar, like S&P 500, diversified 500 stocks in America, large cap, small cap, technology, diversified basket of technology stocks that's traded daily and has a very cheap cost and it's passively managed. That's an ETF. Most ETFs use no leverage, right? So if you want to buy an ETF for $100, you're buying the stock of the companies in there, the collaboration. But some ETFs use massive amounts of leverage, 20, 30, 40 times, right? 40%, 50, 100% more. They borrow a lot of money to buy these stocks. And they package it and they sell it to you as an investment. So you don't have to do the work yourself. But these leveraged ETFs, they've been called the widowmaker, which means men have been known to jump off the cliff, when they lost money. I don't remember about recently, it happened in the 1930s. So you want to be very careful. You can make a lot of money. In a week, your returns could be astronomical, 50%, 80% rate of return. But on the downside, it could also be like that. So to beat the odds, you have to do your research. You have to understand what you're doing. I'm opening up the books on what a lot of professional investors do on Wall Street. This is what a lot of trading houses do. They trade these things. This is what they do. You see this Wall Street people with pinstripe suits, limousines all over, flying first class, making $10, $20, $30 million bonuses. These are the strategies that I'm teaching you for free. Enjoy. So, leveraged ETFs. Now, let's talk about number 6. I think somebody mentioned it. Hey, Kim, it's good to see you. Thank you. Thank you for the analogy. Yeah, home prices in Arizona have skyrocketed. Home prices around the country have skyrocketed. I was in Tucson, Arizona, a few weeks ago, and gorgeous place. The mountains and one of the gentleman I was with, who's a big time developer, he built a lot of the downtown area. He said, the biggest challenge they have is housing. There's no houses. There's too many people. And that's something around the country. And let me tell you something. I called real estate as a bubble last week. It isn't a bubble. There's no way real estate should be going up by 24% year over year. On average, it goes up about 5%, 4.8%, slightly above inflation. But because we're using so much leverage, and because, interest rates are low, so people are buying. The problem is interest rates will go back up. And a lot of the people that are giving out these loans, they're not the banks. Over 50% of these people are not banks. They're non-bank lenders. So what's going to happen when the moratorium ends in September? Now y'all got to pay your mortgage payments. And there's 9.8 million people that are not going back to work yet. So there's no money to make those mortgage payments. There's going to be a lot of foreclosures. When you start to foreclose, and the banks themselves, the ones that are highly regulated and highly capitalized, the JP Morgans and the Bank of America, those are not the ones giving out a lot of mortgage loans now. It's the non-bank lenders. So China has been clamping down on its own people. We got to clamp down on our own people, those non-bank lenders. And what essentially happens when there's foreclosures, those non-bank lenders, they could start going bankrupt. Another financial crisis. It's close to happening now. Carl Icahn, a former arbitrager, now a hedge fund guy, he used to say something very interesting. He said, the market could be irrational longer than we are liquid. What that means is these crazy real estate market could keep going up for the next 2 or 3 or 4 years irrationally, 4, 5, 6 years. It's irrational. There is no way real estate should be this high. It's only because during the pandemic, people didn't want to move. The people living in the houses didn't want to move, but there were a lot of people who lived in condos, who had children. Who wants to raise a kid in a condo for a year and a half? You go stir crazy. So there was demand. Meanwhile, the builders were not building any houses. Who's building during the pandemic? Ain't no workers coming to work during the pandemic. So Real estate is in a big bubble, but the bubble is probably good because cheap interest rates and Federal Reserve, and we have a very a liberal government. We're going to keep making sure things work for another 2, 3, 4 years, and then boom. So if you have real estate, it's a good time to sell between now and the next couple of years. If you want to buy real estate and you're going to hold it forever, you can buy anytime. But if you're only going to hold your real estate for the next 5 to 7 years, I bet you the price of real estate in 7 years is going to be less than the price it is today. I'm a finance guy. This is the kind of things I do, and looking into the future to help you. Anyway, we're not here to talk about real estate. Day trading is that's the number 6 way I'm going to teach you how to make money. You can trade stocks. You can trade stocks, bonds, or any other securities day by day. Day traders use 2 strategies. One of those strategies is called technical, right? Stochastic, they look at different things, right? Technical analysis pretty much means looking back at history and trying to use history to predict the future, the performance of certain things with history. It works sometimes it doesn't work. At the same time, the second technique for day trading is momentum trading. That's when you're trying to make small profits in moves. A company moves by $2 or $3. You buy it, expecting it to move by another $1 or $2 up or down. The thing about day trading is it's one of the quickest ways to double your money, because you're trading during the day really quickly, closing your position out at night and coming back and trading small gains and losses. That's how you can actually make a lot of money. And day traders who are good and who last, and I'll tell you what that means in a second. Day traders who last usually become stars. They write these newsletters, they become hedge funds. So if you become a successful day trader, you become somebody who's wealthy. The problem with day trading, I'm gonna read some statistics out to you. The problem with day trading is it's very difficult to master. It's very, very difficult to master the art of stock, because you're dealing with hundreds of thousands of very smart investors on the other side of the tables, right? With big brokerage firms, with all kinds of research. Now you're this little day trader in the corner of your kitchen with your 2 computers are trying to beat those guys. It's kind of hard. 40% of people who start day trading exit within a month. 40% of people exit within a month. 80% quit within the first 2 years. 80% of day traders quit within the first. 87% quit within the first 3 years. Only 7% of day traders remain after 5 years, but most of those people don't even make money. Only about 1% of day traders consistently make money, and those are the people I talked about become the stars, the star traders. They become the toast of of the blogs and things like that. Only about 1% of people end up being successful day traders. So beware. Penny stocks is number 7 thing we're going to talk about. It's a way for you to double your money really, or triple, or quadruple, sometimes in a week or a month. Let me define what a penny stock is. You know how I told you the stock of Apple is about $145? Well, anytime a stock trades at $5 or under the cost of the price of the stock, it's usually called a penny stock. Well, here's what that means, right? Less regulation, so you have a danger of regulation. You don't have as much information as you need, and it trades electronically. Unlike the stock exchange where they have you've seen the trading floor. There ain't no trading floor. NYSE does have bulletin board and the OTC over the counter, but it's all electronic trading. And pretty much with a penny stock, imagine how difficult is it for a $145 stock that's worth $1 trillion to grow by 100%. Hard. I remember my ex-professor at Harvard Business School in '95. He was my ex-finance professor, and he said, this was the time when Microsoft was growing like 50% every year. Every year, 50% growth, 50%. And he sat us down one day because we were like, Microsoft is going to, he said, look, Microsoft's growth has to slow down. It has to slow. Otherwise, one day Microsoft is going to own the entire world. You can't keep growing at 50%. When you're small, you can grow at 50%. But when you get larger and larger, there's less customers. You've saturated the market. It's more difficult to acquire customers, and so then you start growing 40%, 30, 20, 10, 8%, 2%. Then you become a mature company. Those $2 stocks, $3 stocks, $1 stocks. Many of those stocks that trade on the OTC, those penny stocks, they're growth companies that are growing at 50, 80, 100, 200% per quarter sometimes. So your money could double really fast, especially if you use leverage or options, woof, if they're available. Because sometimes, penny stocks are, sometimes hard to trade. They don't have a lot of liquidity. So it makes it trading options difficult. But they could make you a lot of money. The danger, however, with penny stocks is lack of transparency. If a stock is on the NYSE or the NASDAQ and it's traded, on the trading floor, the SEC is looking at it, and there's a certain degree of transparency because there's so many people buying and selling that stock. Because there's less people buying and selling penny stocks, then less transparent. And so what eventually ends up happening is you don't have all the information you need. Because they're less transparent, in some cases it's more expensive for you to buy stuff, right? Because you think about it, if it's an open marketplace, and everybody knows, what everyone's paying, then, the prices are fair. But like with penny stocks, not everybody always knows what everybody's paying because it's kind of opaque. So sometimes you get screwed with that market. In addition, it's prone to fraud. You ever heard of these pump and dump? When you get these, by the way, never buy a stock because you receive an email, right? Never, never, never buy a stock because you receive an email saying, oh, this stock is I can receive those things every week. Oh, the stock is going to go up in value. It's going to do great. It's going to be amazing. It's going to A lot of those people, I don't know about any legit person that does that. A lot of those people, what they're hoping to do is they want you to buy the stock and me to buy that, everybody to buy the stock. The stock price goes up because there's demand. When the stock price goes up, they dump it at the higher price and leave us holding the bag when the stock finally comes down. They make a killing. So you ever watch Wolf of Wall Street? That's what they did. Don't be a victim. Don't be a chicken amongst the wolves. But if you know what you're doing, you do your research, you're smart about it, or you have a great advisor, penny stocks could double your money for you in a short period of time. We got 3 more to go, so I'm going to speed through really quickly. Cryptocurrency, trading cryptos could be a great way for you to double your money. Now, just so you understand what a cryptocurrency is, it's a digital currency, right? It's not like dollars that you hold. It's only online, and it's stored in a place that's called a ledger, otherwise called the blockchain, right? Where there's millions of people on this blockchain that make up this entire blockchain. You make new, unlike the Federal Reserve that prints new currency, this one is created through a process called mining. You have to solve some very complicated computer equations, some computer formulas, and then you're able to mine new coins. Now, Bitcoin could be great because it, as an investment and to trade it regularly, because it's transparent. Ain't nobody bothering you. You do whatever you want whenever you want it. There's no SEC or government following your every action. It's anonymous. Nobody knows who you are 24/7. If you're awake and you're active, you can trade Bitcoin and you can make a lot of money. On the other hand, it could be very difficult to understand. Unlike say buying a stock, where it's like, okay, I'm buying a stock of a company. If it sells more computers, it goes up. Doesn't sell computers, it goes down. Bitcoin is very complicated in the structure. And it also has, every week there's a new coin. It's like some of those coins are like under $1. It's very volatile. I remember in April, Bitcoin was like $63,000. Somewhere around that. Now it's like $34,000. That's almost a 47% decline. How would you feel if you lost 47%? You may not feel too bad if you bought the stock, if you bought the Bitcoin at 1,000. Now you just made a lot of, so you can make a lot of money with these things. You just have to be aware of the risks. Okay, and by the way, with Bitcoin, you got to be careful because, if you keep your Bitcoin in a cold wallet, like most people, well, a lot of people do, that's where it's offline, but you use a key and you lose your key, it's gone forever. In my industry, if the company goes bankrupt, the government, will kind of come in and helps, through what's called the SIPC, Security Investment Protection Corps. They'll help, guarantee some of those payments that investors lose. There's especially when they're held by the brokerage firm. They don't guarantee the investments, the stocks and bonds you buy, but if you have like cash and other securities, they help with that. Also, there's the FDIC protection. There's many protections that stocks and bonds and actively regulated investments have. Cryptos don't have that. So if you lose your passcode to Robinhood, or you lose your passcode to Fidelity or Schwab, You call them or you go online and you get a new passcode. You lose your you lose your passcode in the cold wallet key. It's gone. That 50,000 is gone. So it does carry some risks. IPO stocks is the second to last thing we're going to talk about. IPO stocks are an amazing way to make a killing if you can get in. Let me tell you what, in 2020, the average gain in IPO stocks on the first day was 36% in 2020. So if you can get into an IPO, woo, by the way, I did IPOs many years ago. My first job after Harvard Business School was I went to work in Wall Street with Salomon Smith Barney. And actually, Jamie Dimon, who now runs JP Morgan Chase, was my boss. I got to work with JP Morgan, very, very smart guy. But a lot of what I did was take companies public. Actually, some of the cases I worked on with Jamie Dimon was on those, he was sort of the one who opened up the door for us in terms of getting a lot of business. And we also used to go recruit at Harvard Business School then, because he was an alumni and I was a more recent alumni. And so so that's how, I got to meet him and got to know him a little bit then. But I put companies on the stock market. I did IPOs. So I understand that as amazing as they are, and everybody wants IPOs, because they make you so much money. They could also lose you money. I mean, look at the company called Didi. They went public right before July 4th, and the government of China came in, and now the stock is down, more than 20%. An IPO is when a company that's been in existence for a while decides it wants to no more be private. It wants to sell its stock to public shareholders like you and I. We can now buy into that company. So they do very well. On average, I think something like 70% or so of those stocks go up. So if you can get in, but it's hard to get in. Sometimes, you got to go to the underwriter, like Morgan Stanley, like JP Morgan, like companies like Goldman Sachs, or you have to kind of beg them. Or you're a big trader, like a hedge fund, or like Fidelity or T. Rowe Price that does a lot of business with them, then they'll give it to you. If you're a small guy, sometimes, they don't pay you too much attention. So IPO stocks could be a great way to double your money really fast. And the final thing we're going to talk about today, the final way to double your money quickly, is currency trading, foreign exchange trading. Many of you have heard about it. Many of you don't know what it is. Now, foreign exchange trading is something very interesting because it's where you buy or sell different currencies in different markets. It's one of the most widely traded security in the world, foreign exchange. It's a massive, everybody trades, well, not everybody, a lot of people trade it. And you can buy dollars, you can buy euros, you can buy almost any currency, and you can sell almost any currency, and you can do it in a way that makes you money. Now, I used to have some good friends on Wall Street who did this, arbitrage using currencies. They would look at the cost of euros, and they would, look at it overnight and, oh man, euros are, there's a disparity between the cost of euros on one market in Europe and the cost of euros over here on our market. So they'd buy it here and they'd sell it over here, and they'd do trades like that. And the money they made was risk-free because they were buying and selling at the same time. An overpriced security they sell, an underpriced security, same security, overpriced here they sell, underpriced here they buy. It's called arbitrage. That's where hedge funds came from. A lot of the Carl Icahns and Ivan Boeskis were originally arbitragers, right, before they became hedge fund managers. Anyway, so arbitrage is no risk profit. With currencies, you can make no risk profits, but it's been getting harder and harder because, well, now there's millions of traders, there's hundreds of millions of dollars, are chasing this same market. So it's easy, it's more difficult. So now you have to bet. You have to take more risk. You could make a lot of money with foreign exchange. You could use a lot of leverage with foreign exchange. Your returns could be fast. It trades 24/7. You could be up at 2 a.m. and go make money. Why not? What's wrong with making money at 2 or 4 or 6 a.m.? The problem is you could also lose money at 2 or 4 or 6 a.m. And so you want to be very careful. By the way, there's many platforms. You can buy foreign exchange, sell foreign. You can have automated strategies. Pick a strategy you think is going to work, set it, and just wait for a couple of days and just see how it plays out. So it's easy to get access to trading, but it's important for you to do your homework. And that goes for everything I've talked about today. Please do your homework. Let's see what my friends are saying. Yvonne, there's a lot of IPOs for 2020. research them and keep costs. Yes, there's a lot. I mean, they've been the IPOs this year. I think they've been more IPOs this year than they were last year, a lot more because of the pandemic and things like that. But, you do want to be very careful. Stocks are very expensive now, right? It doesn't mean they're going to go down, but be careful, with some of these strategies I'm teaching you. Let's see. Rhonda said, I make enough to make a good living. Now, that's the most important thing. There's this thing called the hierarchy of needs, and it starts with, you need basics. You need food, you need shelter, you need, companionship. Once you achieve some of those things, then you can stretch for a little bit more. I want to buy a nice house, I want to buy a nice car. And then when you have those things, and those things are secure, then you can stretch. You can buy IPO stocks. You can short. You can do, but first make sure you've taken care of your basics and taking care of the things that are important in your life. Yvonne said, I love penny stocks. Anybody who tells me they love penny stocks, that tells me they've made money with penny stocks. Good luck and good for you. But do be careful though, with penny stocks, make sure that you know what you're trading. Some of those stocks, some of them are scams. But not a lot, of them. Some of them are. So make sure you're not a victim to those pump and dump schemes. Make sure that when you buy, a penny stock, you follow it and that you have a strategy. If you buy it and it goes from $5 to $9 or something, if that's your strategy, that's what you think it's going to sell it. Don't get greedy. And if it goes down, 10, 20, 30, 40, and you think, look, I can't handle that risk, don't wait for it to go to zero because they could go to zero. It could go bankrupt. Quite a few of them do. Have a strategy before you start buying. Shirley said, what do you think about Dogecoin? Shirley, you've heard me talk about cryptos ad nauseum. Well, let me tell you what I think about cryptos in general and what I think about Dogecoin. If you're asking me that question, please don't buy it. Here's why. Cryptocurrencies, like I just described them, so I won't describe them again. But here's the feature that's different with cryptocurrency as an investment versus any other commodity. Cocoa, I can put the chocolate and I can drink it. Gold, I can wear. Copper, I can use in my house. Aluminum or platinum, I can use in my car. Cryptocurrencies, I can't use except to buy and to sell. The value of a cryptocurrency is what somebody else is willing to pay. So if that person is not having a good day, or a good week, or those group of people are just whatever. Elon Musk, remember what happened? He buys a whole $1.5 billion or whatever and says, hey, Dogecoin, everything goes up. It comes out one day, I don't like these miners, all these people who are mining and they're killing the environment, which is kind of true. Actually, they are. Coal and all those things. I don't like that. I'm not going to accept it anymore for buy my, and then it goes down. Cryptocurrency, Bitcoin was 63,000 or so in April. Through 2-3 months ago. Now it's 37,000. Actually, no, it's 34,000, 33,700. Can you take on that risk? Probably not. So if you can, if you don't need to, don't buy it. But if you do your research, do your homework, you spend the necessary hours keeping up to speed on what's going on with your investment, then it's okay to put a small percentage of your investment in there, of your assets, maybe 3%, maybe 1 to 5%. After all, it's part of diversification. Good question. Let's see who else. My blockchain. Oh man, Rhonda said her blockchain was hacked. That is so sad. You know what happens? You just lose it all. So sad. That's the danger with cryptocurrencies. Let's take one more. Let's see what else. Man, there are a lot of people over here with a lot of good, a lot of good comments down here. Yvonne said, people need to be careful. I had a conversation with a client recently about the real estate industry. Need to be smart. Absolutely. I've talked about real estate ad nauseum. I ain't buying real estate now. I'm going to wait for another couple of years. 2 years, 3 years, however long it takes for it to start coming down. And it is going to come down hard, but it might be 5 years from now. I don't know. It's best to start building my capital. So when it crashes, I can go there and snap up real estate. My friends, it's been a pleasure. Nice seeing you. Love you very much. Talk to you soon.